Today I want to talk a little bit about Hasbro, toy company. We don't get to talk about toys too much unless you count Sturm Ruger and Smith and Wesson in that category. So yeah, I kind of want to remind you too as I go through these. Yeah, I come to Morningstar and I spend a little time here. Okay, and this is where I find the stuff that would lead me, if I were doing a research paper, that would lead me to the annual report to figure out the whys. Okay, that's the part you need to do. Okay, you need to do this too, obviously, to come up with some of these things, but you need to go to the annual report and figure out the whys. Okay, I want to quickly, talk about a D paper is one that's going to come and tell me. Let me go to the income statement here. It's a D paper is going to say, well, Hasbro sales in 2011 were 4.286 billion, and now they're at 4.448 billion, and their cost of revenue went from 2.175 to 2.056, and that is a D paper, okay, or worse. Okay, what we got to do is get inside these numbers a little bit, and I know that's hard for me to explain. It's really hard unless you are grabbing this and looking at some of these things and saying, ooh, okay, that makes some sense. I need to go look that up then and see what happened or why that's happened. Okay, Hasbro's a cool company because they make toys, but also I found some interesting things in looking at them. When I look at just these numbers like this right here, they look kind of boring, right? Revenue from 4.286 to 4.448 in a period of 5 years. That's really not a very good increase, right? It's not. But let's take a look. So, cost of revenue now from 2.175. So, when their sales were 4.3 million, let's say, their cost of revenue is 2.175, and now their revenue went up just a little bit, but their cost of revenue went down. Ooh, I'm onto something. Okay, and I'll show you a little bit more, as to why that's important and what I would talk about then. I think if I were doing Hasbro, let me rephrase that. What I would have to go and look at in the annual report, try to figure out what's going on. Okay, a few other things have happened. Okay, and I'm going to go look at some percentages and I think that'll give us a little clearer, maybe detail about some of the things that are going on. But certainly, it's not going to give us enough to tell us what's going to be in the annual report or reports. They're spending more on R&D. Okay, sales and general admin expenses have gone up. So some of those other things have, so their total operating expenses are, a little bit higher. Okay, but their operating income has made a nice increase, and from 2013 especially to 2015, that's dramatic. Okay, that's dramatic, and most of that occurred, well, in 2013 to 2015. Their sales had dropped down, so we did see a nice increase in sales, but we saw that increase in sales with hardly any increase in cost of revenue, right? From just over 2 billion to just over 2 billion, right? So they increased sales by 350 billion and 40 million in, or I'm sorry, 350 million and then 40 million in increased revenue cost. Wow, that's impressive. Okay, and so, man, this is what financial management's all about. Okay, if you're the CFO of this company, you're the one that's kind of making little marks and whatnot, making some of these decisions that are leading to a little bit higher margins. And as we've oftentimes talked about, those higher margins, even though it's a percent or two, can be really impactful. And we'll see that, I think, as we look at some things. Here was the main one that really caught my eye, okay, when I first looked at it, and this might be what you guys would find, is that here we go. Earnings per share were $2.20 in 2013. And again, without a lot of increase in revenue, 300, over the 3 years, the revenue's gone up by 9-10%, something like that, about 9%. But look at what happened to their earnings per share. Went up 3.61. My first reaction was, oh, they must be buying back a lot of stock. Yeah, they've bought back a little bit of stock, and I would certainly look that up and see, if that's something that they plan to continue doing, something that's, intentional. Obviously, it's intentional. So they bought back a little bit of stock, but I kind of glanced at that and I said, man, that's not all of it. Well, the rest of it's up here. Okay, it's in those margins. Okay, maybe a better way to get a look at that is looking at the percentages, right? Okay, its cost of revenue has gone from 50%, roughly 50% here, down to 46%. So its gross profit then has gone from 50% up to about 54%. Okay, that's a pretty big, that's a pretty big deal. Total operating expenses, 39 to 38. Okay, so that's decreasing operating expenses as a percentage. That's again a small percentage, but then when you look again at the 3-year thing, we've gone from about 11.5 in operating income to over 15.5, a 4% difference. And on $4 billion, that's a lot of money. Okay, and that's what has allowed them to increase their earnings per share from 220. It's one of the big factors, from 220 all the way up to 361. Okay, so that's a huge deal. Okay, and if I'm looking at them, and I can go back to 5 years too and say, look at that, we had from a little under 14% still to 15.5%. So we've still had a nice increase there in operating income. Again, just 1.5% or so, 1.7, but that's still pretty dramatic when you talk about those kinds of sales and whatnot. Okay, I also I'm going to switch back to dollars and go look at the balance sheet a little bit, because I found something here that I'd have to probably take a look at. They've done a nice job. They've increased their cash and equivalents. Okay, just straight along. That's you probably like to see that. Okay, pretty good cash management. You can have too much cash, but I don't think they're in that realm yet. Total current assets, nice. They're bumping those up. So financially, they're really, really strong. Okay, that's a big plus. Gross net plant and equipment, not a lot, so they're not having to invest a lot in capital assets. Those are good things. Goodwill, they picked up a lot of goodwill here. You might need to see what happened, from 2012 to 2013. Why'd that goodwill jump? Normally, a jump in goodwill would have been because of an acquisition. And so a person ought to take a look at that and see if they had an acquisition there, $120 million that got added to goodwill. It might have added some to total assets. I don't see it, though. We don't see, we see gross property and plant jumped up, but that's kind of a steady, just nice increase. So, I don't know. I mean, what happened in the goodwill there would be interesting to find out. We also see, a huge jump, big jump in short-term debt there. And then it looks like they kind of reversed courses. And here they had a big drop in long-term debt. So it kind of looks like they went from having a lot of long-term debt to having more short-term debt, and then they kind of reversed and went back. So something happened in 2013. Combined the goodwill, the debt thing, and why it switched from more long-term to short-term, and then in 14 it went back, more short-term than long-term, and then in 14 it went back to long-term. Okay, and so that would make me a little curious. I think I'd need to kind of take a look at that. Their retained earnings and their equity management looks to be just pretty static. It does look like they buy back a little bit of stock. Okay, so a person might want to take a look at that and see if that's a part of their ongoing plan is to continue buying back stock and whatnot. So, okay, I hadn't looked at the cash flow. We'll take a quick look and see if that tells us anything. Investment, purchase of, here in 13, purchases of investments. So that affected their cash flow, minus 111. I don't know if that had an effect on their, that their dividend payment went down, common stock repurchases. Here in, look at that in 14. Common stock repurchases was a big number there. And way back here it was a big number. Debt repayment and debt issued. Yeah, so some interesting things, some interesting financing. That goes from 13 to 14. Again, it looks like they paid down some short-term debt, but they issued some bonds. So they had a big bond issue in 2014, it looks like to me, and then some other financing activities. So between 13 and 14, some weird things kind of happened there. Weird is not the right term. Some interesting things happened there with their balance sheet and their cash flow, mainly in terms of their debt financing, and maybe they had some debt come due, and so they paid it off and just issued some new debt. It might be something really, really simple, okay, but the numbers are big enough in comparison to Hasbro that it's worth taking a look at. So I'm not going to spend any more time. I'm trying to keep these short and a little bit to the point. Got a little over 10 minutes there, but I hope that gives you guys an idea of some other things to look for. Flop, if you're using Morningstar like I am, here in the cash flow it doesn't switch, but if you're looking at the income statement especially, okay, again, these numbers might not jump out at you. They do if you really start looking at them, like I did here with the cost of revenue and figuring that out. But when I click on this, wow, from 50.7 down to 46.2, that's 4.5% almost improvement in cost of revenue or cost of goods sold. And again, that's a huge thing. That's a huge number for a company like this. So you can play around maybe and flop back and forth between the dollars and the percentages. You could also go back if you wanted to for, I guess 10 years is premium. We can't go back. I'm sorry. I thought we used to be able to. So look at them again. There's things here that I don't know the answers to because I don't see them right here in this particular report, but that would lead me to open up my annual report for those years and try to figure out what happened and what the plan was and why they did it, on and on and on. Could be simple explanations, okay. This cost of revenue thing's a big deal for Hasbro. Small percentages, really, but huge in terms of the impact on profit, and as we see in terms of the impact on earnings per share. And as a shareholder, this is what concerns me. I mean, gosh, from $2.20 a share up to $3.61, yahoo! I can go for that. I mean, this increased by 9%. This increased by, what's that, 50%? Oh, more than that, about 60% increase there, something like that. So huge, okay? So find those things, see what's making them happen, and that's the parts that you put in your financial report. Thanks, and have a good day.